Today, who knows what's real? The DFA Daily to the 6th of August 2020. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and problem news with a distinctively Australian flavour and with a touch of philosophy on the side. The Melbourne Institute has released research on parents soaring mental and financial stress arising from COVID-19. In mid-May, 56% of survey participants anticipated they would be personally impacted by the virus for longer than 6 months. 8 weeks later, 67% now expect the effects to extend for longer than 6 months. And additionally, after a period of decrease, the proportion of people vulnerable to mental distress has edged up since June, suggesting a sharp reversal from the downward trend. Parents with children at home appear to be faring the worst when it comes to mental and financial stress. Parents represent a large proportion of the working age population, the Institute said. COVID-19 is adding to the stress parents face on a daily basis, which can have flow-on effects to employment, finances, and the well-being of partners and children. As we look toward economic recovery, governments and employers may need to consider targeted policies designed to support this specific group of Australians. With the COVID-19 pandemic, they are now the most distressed group. 25% of fathers whose youngest child is aged 0 to 4 and 33% of fathers whose youngest child is aged 5 to 11 report high levels of mental distress. Among women, mothers used to have better mental health than childless women, but now they've lost that advantage. Overall, they are now noticeably worse off than women without kids. And among mothers, mental distress has increased the most, from 9% to 22%, for mothers of older children, youngest child aged 12 to 18. Childless men and women have also experienced increased levels of mental distress with COVID, but less so than parents. Since the beginning of the pandemic, there has been a strong connection between mental distress and experiencing financial stress. Financial stress is potentially the most important mediator for mental distress, but not for everyone, they said. Non-employed fathers indeed displayed much higher levels of financial stress at 51% than employed fathers at 37%, or other non-employed groups around 30% on average. And on the other hand, financial stress does not explain the very high levels of mental stress experienced by employed parents with children aged 5 to 11. They experience financial stress at rates very similar to other parents. The alarming levels of distress experienced by these parents are plausibly caused by life changes beyond their family's financial situation. For example, widespread working from home arrangements and school closures. And before drawing further conclusions on this point, they checked whether employed parents of children aged 5 to 11 were more often affected by other negative labour market experiences or worries around losing their job, and they find this to be an unlikely explanation for the level of mental distress they've experienced. And now today, we released the full mortgage stress data, which shows that 40.2% of all households are now registering mortgage stress. That's a new record, and it looks likely to be broken again in the months ahead. Of course, we went through that in significant detail in our live stream on Tuesday. And meantime, the ABS reported that lending volumes bounced back in June, but stage 4 lockdown measures in Melbourne are set to have a material impact on demand over the coming months. The recovery in lending was spurred by an 8.1% growth in the value of investor lending to $4.4 billion in the month, and this followed an 11.6% plunge in May and a 4.8% slide in April. The total value of approvals, excluding refinancing, rose 6.2%, reversing about a third of the 15.8% decline over the previous 2 months. That fall compares to the steep 40% drop in turnover during the March-April lockdown, with a similar sized rebound in May and June. the lift was broadly based, but with notable pockets of weakness in New South Wales and around previously very strong refinancing activity. The value of new loans to investors rose 8.1%, outperforming owner-occupiers by the widest margin since August last year, with the latter showing a 5.5% increase in the value of owner-occupied loans to $13 billion. And the number of loans posted a milder 7.1% rise and are still down around 2.3% over the year. Investor loans were coming from a very low base, of course, and May marked the lowest monthly value in 17.5 years. The growth in the value of investor lending rose to $4.4 billion. Looking at new loans excluding refinance, we see the movements in marginal activity that drives credit growth and housing demand. But it's worth noting that refinancing flows, which have been very strong as householders sought out lower rates, now has declined 11% in June, but is still up 55% across the year, suggesting the boom in refinancing is now cooling quite rapidly. And the rise has been strong enough to have total loan approvals, including new and refinance loans, up 21.6% over the year. And within the owner-occupied segment, first home buyers posted a further gain, up 3.3% to $3.8 billion in June, following a 10.5% fall in May, but construction-related loans, including loans for the purchase of newly built dwellings, were steady. The latter should get some support in coming months from the federal government's home builder scheme. The standout, though, from the state breakdown was a continued decline in Victoria, down 5.8% for the value of total loans excluding refinancing. And that came against the run of solid double-digit growth across all other major states. This divergence is set to widen, of course, dramatically as Victoria moves back to hard lockdown. And that, of course, will impact the numbers in coming months. On the other hand, Queensland led the nationwide improvement, recording a 19.5% increase in the value of owner-occupied lending volumes. Now, the Financial Services Royal Commission leader, Kenneth Hayne, has suggested governments are referring too many matters that could be dealt with through legislation to independent inquiries because they've lost the trust of the people to govern. Addressing the Victorian University's Sir Zelman Cohen Centre for Legal Training on Wednesday, Hayne said the degradation of political debate and the resulting lack of trust across Australia and other developed economies' governments have meant that the public no longer trusted parliamentarians to address significant problems in society. Slogans supplanting reasoned debate about policy may go some way to explaining why, in recent years, difficult issues of public policy have often been referred to Royal Commission and other external inquiries, Mr. Haynes said. These bodies generate reports that are or should be independent and reasoned. Frequent use of independent commissions of inquiry may suggest that governmental structure can now deal effectively only with the immediate emergency and cannot deal with the larger issues that face us. One reason that may be so is that the space left by the absence of reasoned debate is filled with slogans coined by partisan participants. And this happens even where the basic information on which reasoned debate would be based is freely available to the whole community. Mr. Hayne mentioned Indigenous constitutional recognition and climate change as two key issues which should become subject to sloganeering and peddling of misleading ideas in Australian political debate, as well as Brexit in the UK and Russian interference in the US election. Nativist, populist leaders have come to the prominence they now occupy by endless repetition of slogans, accompanied too often by repeatedly denying the undeniable and shouting down those who would speak truth to power, he said. As a result, trust in government, as well as other systemically important institutions, has been degraded. He said, in order to force these institutions to become more accountable, the public must insist upon absolute honesty and integrity. We must do what we can to impress upon those who seek office that power is not the objective, that having the numbers in the branch, the faction, the party, the legislature is not the end, he said. What matters is what our democratic institutions do and how they do it. And all our democratic institutions are based upon reasoned and informed debate. And Mr. Hayne also cited steps taken by the government during the COVID-19 health crisis as a good example of institutions communicating the need for significant change in a factual manner. Governments have very quickly made radical changes in the way we live and work. They have done that by telling society the facts as simply and as clearly as they can, he said. Society has responded to being trusted with the facts that are known and has recognised that difficult judgments have had to be made, and governments have brought about great changes so that together we can pursue shared purposes. Now, over at UBS, there were some excellent observations. 2 steps forward, they said, 1 step back. With Melbourne moving to level 4 lockdown, all non-essential businesses closed, the outlook for the Australian economy and banks has deteriorated sharply. After a strong economic bounce from May until early July, this is a clear setback. While the assumptions underpinning the bank's overlays in their March results look relatively conservative, this may no longer be the case, especially in Victoria, they said. We still expect lower credit impairment charges with the June results updates from the 12th of August, given limited new non-performing loan formulation as a result of loan deferrals. However, banks are likely to be rewarded for provisioning prudence at this time. The dividend you pay when you're not really having to pay a dividend, they said, given APRA's vague instructions that banks can pay out up to 50% of earnings in dividends, but these must be offset with DRPS or other capital raisings, UBS believe boards will have an awkward decision to make. Should banks return cash to shareholders, then immediately issue new shares to offset the hit to capital just to create an artificial yield, an artificial dividend? Unless shareholders participate in the capital raising, the board is effectively reducing investors' holdings via dilution to give cash back to them. With every bank excluding CBA trading below book value, they believe this is economically irrational, and they believe all shareholders must recognise that bank dividends are not an annuity, especially during the depths of a recession, with 11% of mortgages and 70% of SME loans on deferral, and with 25% of the population returning to lockdown. Lots of moving parts with these results, and there are other considerations too. They said net interest margins will benefit from mortgage repricing, cheaper short-term funding, and deposit cost offsets the impact of rate cuts and loan mix. Trading income may spike higher, as seen with global banks, while fee income may be impacted by lower activity and waiving merchant fees. And, of course, there are elevated costs to worry about, and credit growth forecasts probably will get downgraded as Australia enters a deleveraging cycle. So there is some appeal in bank valuations, but they said the macro concerns are likely to override any near-term upside. Overall, they expect this reporting season to provide significant insights but little clarity on the outlook, and they anticipate a renewed wave of charges in financial year 21 as the full impact of the recession is felt. And this leads to a W-shaped earnings recovery. They believe the linchpin to the bank's performance will be Australia's small businesses, which may drive unemployment and house prices, as well as the level of ongoing government policy stimulus. And next, a load of tripe from the RBA as Dr. Tulip, I kid you not about the name, tries to argue that there is an apartment shortage in Sydney. What you say? Exactly. This paper measures the excess demand for apartments in Australia's largest cities. They estimate that home buyers will pay an average of $873,000 for a new apartment in Sydney that only costs $519,000 to supply, a gap of $355,000 or 68% of costs. There are smaller gaps of $97,000 or 20% of costs in Melbourne and $10,000 or 2% of costs in Brisbane. The large gaps, they say, are sustained by planning restrictions. The shortage of apartments is most severe in the inner suburbs of Sydney, where height limits prevent more construction. Elsewhere, restrictions on converting low-density housing to apartments are important, and high-rise apartments are a much less costly means of supplying extra housing than the medium-density housing that some planners favour. Planning regulations restrict the supply of apartments and hence drive up their price. This effect can be measured by the difference between the price of new apartments and the cost of supplying them, and they estimate this gap to be large, especially in Sydney. Specifically, planning restrictions increase the cost of apartments by 68% in Sydney, by 20% in Melbourne, and 2% in Brisbane. One way of supplying extra apartments is to build taller buildings, they said. This increases per apartment construction costs, but means that extra land is not required, and their estimates allow for these higher construction costs together with costs of finance, marketing, professional fees, infrastructure contributions and developers' margins. And they conclude that in Sydney the effect of restrictions increased strongly as you get closer to the centre of the city. The largest effects, averaging more than $450,000 per apartment in 2011 to 16, occurred in inner ring areas like the eastern suburbs, Leichhardt and North Sydney. However, even though the excess demand for apartments is greater near the centre, building patterns do not reflect this. Recent and planned construction in Sydney is located predominantly in middle and outer suburbs. In Melbourne and Brisbane, the effect was unevenly spread through the metropolitan areas. And while they focused on the costs of adding additional floors to apartment buildings, an alternative way of supplying apartments would be to construct more buildings, and this requires the purchase of land, which is expensive, especially in Sydney. For short buildings, land costs amount to hundreds of thousands of dollars per apartment. For this reason, medium-density housing in the form of low-rise apartment building is much more expensive to provide than high-density housing. As building height increases, they said, the per apartment cost on land declines while construction costs increase. So above a certain height, tall buildings become more costly to build than more shorter buildings. In Sydney, under central assumptions and on average across the metropolitan area, this crossover point occurs at 20 stories, much higher than the typical apartment building, which is 10 stories. This cost advantage of taller buildings is largest in Sydney's inner suburbs, where land costs are very high and where, in the absence of height restrictions, it would be economic to raise building heights by 20 stories or more above their current heights. They said, in contrast, the benefits of raising building heights in Melbourne and Brisbane are smaller. This is partially because land is less expensive. It does not need to be used so intensively, and partly because apartment building in these cities is already close to the economically efficient height. To which I reply, gasp. Now, this is the analyst who does not think credit growth has anything to do with home prices, and some time back argued that Australian housing is 30% undervalued and that owning a home is now, quote, more attractive relative to renting than it's been for any time in the past 30 years. Look at recent rent slide, eh? The property bulls love him, of course, because of his linkage to ever lower interest rates reducing repayments, though, of course, that is running out of runway now. And bear in mind, we have very high vacancy rates, more property coming on stream, and the essence of his argument, if applied to the US or Ireland or even Spain at the time of the global financial crisis, would have signalled a shortage there too, countries where, just to remind you, property tumbled by up to 40%. And that, my friend, is a bubble. And Mr. Tulip is well named, remembering the great tulip bubble, which dramatically collapsed in February 1637. And by the way, that profile may well apply to property, or perhaps even to gold. Now, we could discuss gold at length, and sure, the bulls are doing just that. But as I discussed recently with Steve Van Meter, one of the most important influences on gold is the real yield available on bonds. Gold doesn't pay an income. And this becomes less and less of a problem as bonds pay less in real terms. At present, real 10-year yields are more negative than they've been since inflation-linked bonds became widely available. One critical development of the last year is that the US has joined Germany in having very negative real yields, which presages a weaker dollar, as well as higher gold prices. Real yields form the backbone of one of the most interesting models of, quote, fair value for gold, produced by City of London veteran Charles Morris, the founder of BiteTree.com. His model is essentially a zero-coupon 20-year Treasury inflation-protected security, or TIPS, and thus rises as long-term real yields fall. The factors included in the model are inflation, real interest rates around the 20-year mark, and the speculative premium or discount, plus a series of secondary factors including the US dollar, which of course is a consequence rather than the cause, central banks, wars, bad news, jewellery demand, which can be counter-cyclical, and even mine supply. And they model fair value for gold compared to the actual gold price over time. The bullish scenario is that central banks keep doing what they're doing, squashing real yields ever lower and continuing to raise the fair value of gold. But then inflation may at last begin to become untethered and rise towards or even above its upper 3% target, which is conceivable, but of course some years away. And then retail buyers enter in a big way, a while after that perhaps, and then gold would probably decline. But maybe the ride to get there would be lucrative nevertheless. The risk, of course, would come in a change of central bank behaviour, just as the last gold peak turned into a bear market once the Fed started to try to move away from its unlimited asset purchases. Or to put it another way, we are very much in the hands of what the Fed does. And the question becomes, do we think the Fed is likely to ease off on its printing, or will it go on printing? And if it does go on printing, what will that do to bond yields? But as Steve said the other day, we need to be watching the bonds very closely, because perhaps in the next 60 days or so, we're going to see some very interesting developments. More on that in a later show. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.